Hello to everyone. My today's topic is money printing mechanism by the central bank. I am going to present this topic on my channel Financial Reality. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel that is Financial Reality. First of all, what do you mean by money? Money is the tangible form that is a paper bill and coin that we use in daily life as medium of exchange. Medium of exchange is an intermediary instrument or system used to facilitate the purchase and the sale of the goods and services between the parties. Types of medium of exchange. First of all, paper currency and or coin. Secondly, barter system work as the exchange of services or commodities. It's one of the oldest systems that is still using in some areas within the globe. And the most latest one is the digital currency. Money printing mechanism. Money print means new money to the economy by the central bank called as reserve money. Reserve money is injected by central bank in the economy to meet the amount of the growing transaction based on estimation because of economic growth due to inflation and GDP growth. Basically, inflation and GDP growth create a gap. And in order to fill that gap, central bank used to inject new money within the system. Inflation increasing consumption and GDP increasing trading of the goods and services value both lead to increase in the value of money circulation. Money printing mechanism. There is an other scenario when the inflation having increasing trend, but the GDP growth adversely. Under such situation, the central bank take the measures to devalue the domestic currency to manage the increase in the value of the money circulation and increase the interest rate, and interest rates are also called as policy rate. The devaluation of domestic currency provide the cushion against the foreign currency deposit billions values to print new money and increase interest oblique policy rate, keep the banking system stable. Basically, every investor wants the real rate of return. Real rate of return is basically inflation adjusted return. If your inflation is going to increase, the central bank will have to increase their policy or interest rates. Interest policy rate increase may also attract bank depositors that lead to enhance the central bank reserve because of the strategic reserves requirement against deposit that include cash reserves requirement that is also called CRR and strategic liquidity requirement SLR. So these reserves banks will have to maintain with their central banks. Now, normally reserves with the central bank include billion reserve, foreign exchange reserves, balance of payment. Balance of payment is a part of current accounts. The central bank maintain a minimum level of the reserve as per their policy. Important measure to print new money to ensure to make sure the issue of the new money reflecting the economic growth in a healthy way and has sufficient asset to back the value of the issue. It is the job of the central bank to make sure. The most common asset base include the precious metal, foreign exchange deposits, increase the loan granted to the public sector and the banking system, and investing the debt market among other type of the asset acquisition. The more asset a central bank have, the more money it can justify issuing. So it is the concept that you should be familiar uh, mm, with as the role of the central bank for the issuance of the new currency. See you soon with the new concept on banking and finance related topic very soon. Thank you very much.